没静音啊。嗯。行。
Sorry, Professor, cannot hear you.
No, we can't hear anything.
I can't hear you, Professor.
We can't hear anything.
Can't.
Okay, can you hear me now?
I can't hear Professor. Yeah,
You
yeah,
can?
I
Okay.
okay. It's okay.
I don't know how, but this is proving to be quite difficult. But you know, we'll all have to manage. It's not a perfect situation, is it? But it is what it is. Well, hope you all had a good weekend, considering everything that's going on. Hope you are all well. I've already received a couple of emails from people who are not feeling well. I hope that's very, very temporary, and that you all are in absolutely fine mental and physical health very soon. So, okay, before we continue, do you have any questions? All right, we're going to go on to what I find the most exciting aspect of finance, and that is options. A lot of my research and consulting are on options, and I actually, frankly, absolutely love this part of the course because it's so real. It's so much of what we do, the data we study, the empirics we do is so real. So much of the investments that are active, that are for risk management purposes, etc., work through options. It is really where a large part of the more sophisticated action is. By no means are equities or fixed income derivatives or futures and forwards less important. They're not. And not also there we have actually worked with actual data. So it's not like we were making things up. So we definitely have been very, very careful with all that. But when we are in the world of options, that's where the sophisticated investor really plays in. So it's good to see how all of this works. This is not a full course in derivatives, as you know, and there are full courses in derivatives that you should consider taking if you are interested. This will get you started. And another thing that will hold for this part of the course, as well as for other previous sections as well, is that I will cover only a part of the lecture notes. You should think of the lecture notes that I have posted on Blackboard for you is to print out and keep as reference anytime you want to know what a particular thing is, or you want to think through certain methods or think through certain logical processes. It would be great to go through those notes as references. So that's how you should think about it. I will cover only parts of it. And as before, we'll get our hands very, very dirty with the data. Not as much as obviously we would if this were a full derivatives course, but we will get ourselves familiar with a lot of how all this works as well. All right, so options without further ado. So first of all, definitions. An option, all this time we have talked about like futures or forwards, those are all derivatives that give the holder the right and the obligation. If you and I, let's say, Yunshu, you and I enter into a forward agreement where you are going to sell me a crude oil at $55.66, or let's say 1,000 barrels of that 6 months from now at that price. You have the right and you have the obligation. That is the nature of every single security we have talked about in the past. Similarly, when you buy a fixed income security, if you buy a bond, you have the right and the obligation to meet the interest payments and to return the money. And similarly with equities, every time it's a right and the obligation. Optionality, the very idea of optionality is the right but not the obligation. And it is because there is this right but not the obligation that you actually have to pay up front to invest in an option. That's the way it is standardized. Now, as you know, any financial transaction can be within the remit of the law, of course, can be structured between willing investors, or arm length buyer and seller. As long as it's better for everybody involved, they can do it. But any kind of standardization is this optionality, is this right but not the obligation. All right. So an option is, so if it is the right to buy a particular specified underlying asset, then it's called a call option. So, so let's say the various different or variants of options. First is whether it's a right to buy or right to sell. Okay, so if you have the, and we'll do an example in just a minute. You know what? I'm going to just introduce it through an example rather than go through the actual definitions. So hold on for a second. I'm going to. All right, I'm going to share. That seems to have vanished. Hold on just a minute. All right, can you see the Google screen, the browser screen? Yishi, can you see the browser screen? All right, so I'm going to just go to the Chicago Board of Options Exchange, CBOE, their website, okay, cboe.com. This is where most options in the US are traded, okay? So let's look at and go to, let's say, quotes and data. Let's go to quotes dashboard. Since we are using Zoom, let's say we want to look at what Zoom's options are. Let me just, okay, what is the, I'm just going to, can you see me going to Yahoo Finance? Can you see the?
Yes.
Okay, I'm just trying to see what the ticker symbol is for Zoom. Okay, you can see it's ZM, okay? The Zoom Video Communications is ZM is the ticker symbol. So I'm going to go back to CBOE. Let's go to quote symbol search, ZM search. So this first here is the price data table, price of this particular security, the Zoom equity. But what we are interested in, what is referred to as the options chain. Okay, let's click on options chain. And let's just look at a couple of examples. First of all, right here at the top, where it says bid $114.87, ask $114.93, those are for the security of Zoom equity. That is what we call the underlying. All right. So these are options that have been written on the underlying security, which is Zoom stock. So the last trade in Zoom stock happened at the price of $114.85. Let's look at the first row that we see where it says strike ZM 113. All right. To the left, as I said, this is called the option chain. The left is what are called calls, and to the right are data on puts. So let's actually go through this example and make sure we understand. What does this particular call option represented by this first row mean? Strike price is $113. It says, now year 04/09/2020, that's the expiry date. What this call option is, it gives you the right, but not the obligation, to buy the underlying security, Zoom, at the strike price of $113 at the expiry date of April 9th, 2020. This is what we would call a plain vanilla option, and I'll get to something in just a minute. So let's say these are on Zoom. All right, let's take instead of Zoom, let's say we take the Standard and Poor's stock exchange. The equity underlying is the Standard and Poor's 500. All right, so the Standard and Poor's 500 here, it is saying that if you look at the top, the last trade for Standard and Poor's index was $2,733. Well, dollar is not the right word. That's the level, because it's not exactly a dollar figure. And what this is saying, this call option at the strike price of $27.25, it means that particular security means you have the right, but not the obligation to buy when? At 04/08/2020. That's the expiry date, also known as the maturity date. So this call option says you have the right to buy 1 unit of the Standard and Poor's index at the price of $2,725 when? At April 8th, 2020. That's a call option. You have the right to buy, but not the obligation. To your right, you have is the data or is information about the put option corresponding to it. This here says that you have the right, but not the obligation, to sell 1 unit of the Standard and Poor's index at the price of $27.25. That's the strike price. That's the price you have the right to sell at for a put option. When? At April 8th, 2020. Okay. This here, there is another wrinkle in the sense of when do you have the right to buy? The Standard & Poor's index option is what we call a European option. That is to say, you have the right but not the obligation at the time of maturity. Whereas what we saw earlier, let me pull that up. Now we're looking at the options chain for Zoom. The options on Zoom on US equity, they're all what are called American options. The difference between an American and a European option is as follows. For an American option, you can exercise that right. Which right? In the case of a call option, the right to buy at the strike price. In the case of a put option, the right to sell at the strike price. For an American option, you have that right anytime between now and the expiry. That's an American option, anytime between now and expiry. Whereas for a European option, for example, that of the any option traded in the US on an individual equity is always an American option. It's just one of those institutional details. Whereas the options on indices in the US, are European options. And that means that for a European option, you have the right, but not the obligation, only at the time of maturity, not any time before that time of maturity. Okay, so these are the definitional features of options. So going back to our slides, to always keep in mind that this underlying, and as we have done before, the buyer is said to have a long position, the seller is said to have the short position. So the buyer or holder of the long position has the right but not the obligation. The seller or the writer or the short position has the obligation but not the right, which is why they get paid. The buyer has to buy it, has to pay. The seller gets compensated for taking on the obligation. That's what they're paid for. So what is that they get paid for it? The price. What we typically do, because of for various data reasons, for the price we typically take the midpoint of the best bid and the best ask. So if we go back to the website that we were sharing, so let's go back to the Standard & Poor's index. The bid here, if you go to the call option, the first row, remember that is, you have the right, but not the obligation to buy 1 unit of the Standard & Poor's index at 2,725. When? Tomorrow, not between now and tomorrow, only tomorrow. That's where the option expires. That's a maturity date. And the bid price for that is 37.4. The best ask is 38.5. So for most of our data purposes, when we talk about what is the price, these are all we're talking about now. These are not historical data. For historical data, we will find ourselves using option metrics, which I'll show you later on today. But this is, we're talking right now. Well, actually, it is delayed by a little bit because so that the people who are actually trading on these data have an advantage. What we get is about delayed by I think about n minutes, where n is small, delayed by that. So the bid price, the best bid is 37.4. The best ask is 38.5. For the price that is being paid for this option at this time, we're saying you take the mid price, the middle of 37.4 and 38.5, which is what, 38.05. Yeah. So that's the dollar price that we would say is the option price for this. Okay. Let's take a couple more examples. So the next, now look at this price here. What is the price today? Is right now, the price right now is 27.33, and this option gives you the right to buy at 27.25 tomorrow. So it's if the price, unless the price goes down substantially, you will make a lot of money. So this is substantially valuable option, which we will talk about it in a short while, about intrinsic value and all that. This here is why this is a pretty valuable option, because there is a good possibility that you will be able to exercise that option. So let's look at the next strike. It's 27.30. That is saying that you have the right, but not the obligation, to buy 1 unit of the S&P 500 index at the strike price of 27.30. And what is the best bid for it? 34.7. The best ask is 35.7. To take the price, we usually just take the middle of that in order to get the price. Similarly, let's look at a couple more examples of puts. For this, the first put on the right is the right but not the obligation to sell. Remember, a put option is to sell 1 unit of the S&P 500 at a price of 27.25. The best bid is 29.6 for that option. The best ask is 30.7 for that option. So when we talk about the option price, we'll typically take the middle of the bid and the ask price to get our best estimate of the option price, the middle of the best bid. And that's something when we do most, because this is intraday data, when there is typically the option actual transactions can vary so much that it's more, it doesn't carry as much meaning. So that's a standard practice we have of taking the middle of the best bid and the best ask to approximate for option prices. All right. The normalized price of the option is the price of option divided by the underlying price. Okay, what are you seeing? What is the screen?
It's there in the CBOE.
Oh, you're on the CBOE page. Okay, good. So here you can see there are various ways of filtering it. You can see filtering by volume. It's often very useful to just keep it at all, or you can look at only options that are actually traded, so with volume greater than 0. This option range, near the money, all or otherwise, let's just look at all, and then we can filter it ourselves. And let's look at, you can look at options that expire, right? All this is showing right now is options that expire in April 2020. So these are what we'll see here are all the options on Standard & Poor that are traded in with have greater than 0 volume, expire in 2020. If you want to look at options that expire in the future, you can do that. You can similarly, let's say, look at options that expire, let's say, March 2021. So a year from now, what are the various options on the same underlying on S&P 500 that you're the various options? And let's just look at, we have looked at the volume all. Let's say we are only interested in those options that have actually traded. So let's say we restrict our attention to all options that expire in a year's time, but have greater than 0 volume. So that have had some trade. So turns out in that case, there has only been a year into the future, trading on March 19th, expiring on March 19th, then we have this one option, which is a strike price of $22.50, and that expires in a year. So you can look at all these kinds of things. So let's go back to those that expire in the in just rest of this month. So first thing, let's look at some examples, a few more examples. The first one let's look at is these options. The first row is where it expires tomorrow, April 8th, 2020. Remember, for an S&P 500, it's an option that you have the right but not the obligation to buy only at maturity. And similarly, for a put, you have the right to sell but only at maturity. All right. I'm going to introduce to you now the concept of moneyness, and I'm going to do the exact calculations in a short while, but let's talk about this idea of intrinsic value or moneyness. All right, so you have the right, but the obligation to, right, but not the obligation to buy, let's say, look at the call option at $22.50. The price, right, of the underlying, excuse me, is $2,733. So, assuming that, let's say if it were just today, if this is the price today, what is the value of this option to you? You could remember the whole idea of trade is buy low, sell high. That's what you have the right to make. So you have the right to buy at $22.50, right? To buy at $22.50. And the price, let's say tomorrow's price is, let's say, the same as today's price. Big assumption, but we're just trying to understand. And the moneyness, the intrinsic value, is calculated on the idea that the martingale assumption holds, the price remains the same. So if under that, if price is indeed the same, of the security is the same as today as it is tomorrow, then you have the right tomorrow to buy at $22.50. So tomorrow you can buy at $22.50 and sell at $27.33. You can immediately make a profit of $2,733.04 minus $2,250.00. Can buy at this lower price and sell at the higher price. Okay, this is an example of an option being in the money, or where the intrinsic value of the option is positive. Let's look at the same option from the flip side for a put. What are you going to do if the price of the underlying security, the S&P 500, is the same as today's price? The price tomorrow is the same as today's price. So you have bought this put option, which is the right but not the obligation, right but not the obligation, to sell at 2250 whereas you can buy for 2733. In that case, you're not forced to sell, remember. Here, you can buy at 2733 and sell at 2250. So you would be, in that case, making a loss of about $500. You're making a loss of 2,733 minus 2,250. So this is a situation where you will not exercise the option. Okay, this is the fundamental difference between a future and forward on one hand and an option on the other, on this hand. Here, if the price at expiry is lower than the price of the security, sorry, if the price of the underlying security at time of maturity is higher than the strike price, then you will let the option expire worthless. You are not going to exercise your right to sell the option. Similarly, let's look at the second row. You have the right, but not the obligation, to sell at 2300. If the price tomorrow is 2733, then what are you going to do? You're going to let the option expire unenforced. Why is that? Because nobody can force you to sell for 2300 what you can buy for 2733. You're not going to sell for a lower price than you can buy at. All right, so this is an example. I've just given you 4 examples of options on S&P 500, 2 of which you will actually exercise your option, and 2 of which you will not exercise your option. So this is how we calculate the intrinsic value. So in order to do the calculations, let's actually download the files and let's do some calculations, see how they go. So if you click on follow along with me, please. Click on download text file. And we're doing SPX. Okay, this is going to be interesting. Why in their infinite wisdom they decided to do it this way. It's a bit of a problem. There are a couple of steps you have to go through. So please follow through with me, okay? So download them to a place where you can remember. Let's say we SPX options today is Mavis, were you able to download the data?
I'm trying to. The internet is super slow here.
Okay.
With the VPN, yeah.
Okay. How about ED? Were you able to download the data? I can't hear you. Rundan? Have you been able to download the SPX data?
Yes, I'm sorry. That mean in my own computer?
Kaishu, have you been able to download the SPX data?
Yeah, I'm trying.
Xingxia, have you been able to download the data? Gail?
Yeah, I'm done actually. This is Mavis.
Okay, good, good. Gail, are you done with the downloading? It will download as a .dat file. As I said, in the infinite wisdom, instead of, we'll have to actually go through a further step. Gail, were you able to download the data? Zhang Yuan, were you able to? All right. So then I've downloaded. So let's go to where I've downloaded it. What you will need to do is open up Excel. All right, so open up Excel. All right, can you see where I'm trying to Excel? Do you see my Excel home screen?
Yes.
Right, then go to open. Go to the directory where you've stored your .dat file, and the thing that gets interesting, you will have to look at not all Excel files, but all files, because you need to look at so you need to open this file that you have downloaded as a .dat file. You will need to open it through Excel. All right. So then use.
Excuse me, Professor?
Yes. Yeah.
When I trying to open it, it's gray. I can't. I don't know. Somehow my screen shows different thing. I'm not just looking for. I can't. Can I share my screen?
Okay. Let me stop my share. Okay. Why don't you share your screen? Yeah.
Yeah. Oh, wait a second. I have to. Oh, I have to quit now to share my screen. Actually, I can actually do screen. I can send you email later. Actually.
No, no, what you, but just let's try once. If it doesn't work, then we'll
Okay.
move on. Just
Oh, can
I've
you
just
see my
stopped
screen now?
sharing. I've stopped sharing, so you should, if you can, you should be able to share.
Oh, can you see my
There,
screen now?
yeah, I can see your screen.
Yeah. So when I was trying to, you can see it's gray. I can't choose it. When let's do open. I choose open, and on my Mac and desktop, I can't choose it. It's
I mean,
right here. This one.
Okay, try choose application through Excel. I mean, the .dat is a data file that the default option, it's not an Excel file. You just have to open it through Excel. So let's try it one more time. If not, we'll.
Yeah, this is Excel. Let's see. So open, and on my Mac. So
Okay.
it just pop up the screen here, and I just can't. Is there any other way we can do this?
Okay, why don't we talk after the class? Okay.
Yeah, sure.
All right.
Yeah.
I really don't know much about Macs.
Yeah.
So
Okay.
that's something we need to. You might need to speak with the university IT people.
It's fine. When I get home, I can use the another computer. This is
Okay.
just a temporary one. Yeah.
Okay.
Yeah.
Well, we'll figure it out. Don't worry, Mavis. Okay, we'll figure it out.
Okay. Sure. Thank you.
You're welcome. All right. So I'm back to Excel. Let me. So as I said, open the file. I'm at downloads.finecon. Make sure to open access all files, because it's not an Excel file. Then open this .dat file. This is what comes up. You're going to use the delimited option, tab and comma. These are the two delimiters that you need. Next, general, finish. So this is what this data here looks like. So first thing here is this says this is the Standard & Poor's index, which is great. April 7th, 2020, that's today's date. The bid for the why is my screen sharing paused? Hi, Hua, can you see my screen?
Yes.
Okay, Yunshu, you're hiding behind your computer. I can't see you. Okay, now I can see you.
I'm sorry, I'm using my iPad. Yeah, I can see you. I can see your screen.
All right, excellent. All right, so you can see all of these various fields. We'll organize them very shortly. So these are all, as you can see in these are all standard options on the Standard & Poor's 500 for 2020, 0407. I'm just going to create another thing and delete the top two rows and move them to that other sheet, because I'm going to need them later. All right. So to remember, what is this here? For the price of the security of the Standard & Poor's, 2702 is the last price. You have the ask and the bid. What we want is this 2702.94 is the current price of the underlying security that we are interested in. So we are going to just keep this in mind. I'm going to so put lots of filters. This is the expiration date. Last sale, net, not interesting. We'll just keep the bid ask. This volume, let's keep it there. IV, implied volatility, is very, very, very important, but not for today. It's one of the most important things to come out of options. In fact, I spend in my research, I do a large part of my research is on implied volatility, but for now, we're not going to worry about it. We're going to just look at some. Similarly, delta, gamma, these are things that come from comparative statics, the Greeks that we will not worry about right now. So delete them. The open interest is I'm not going to spend too much time on it because it's different from volume. So you can think about volume, the relationship between volume and open interest is kind of like the difference between stock and flow. Open interest is the number of contracts that are actually open for that particular option at a particular point. So you, if you sell it off, that open interest goes down. If you open up a new contract, then open interest goes up, and so on. It's something that it's an important metric, but for now, let's not worry too much about it. Similarly, the last sale, net, delete, we're not interested. Volume we need, IV, delta, open interest. Let's not worry about them. So these are the columns that we're interested in. Let's make them so that we can actually read them properly. So let's bold them and actually put filters on them. Okay. First of all, these bids and asks are actual dollar figures. So let's make sure they look like they are dollar figures. Okay. The strike is also a dollar figure. So let's make that a dollar figure as well. Well, the strike is, just leave it there. Similarly, this bid and ask are dollar figures. And finally, these volumes are numbers with no decimals because, so volume with the comma. So this here is the strike price. This here is the price of the this the call option. Okay, let's make sure we understand this highlighted row. That this here is an expiry date of April 8th. That's tomorrow. This here is the call option at a strike price of 700. That is to say, if you buy that contract, then you have the right, but not the obligation, to buy this particular underlying security at the price of 700 when it expires April 8th. Now, whether that's a valuable contract, that's a valuable option or not, depends, of course, on what the underlying price is. Now, and these are all options for today. These are all options that are being written not only today at 10:55 a.m., or rather when the data was collected, when about 10 minutes ago, that we were, it's the data as of 10:30 a.m. of April 7th, 2020. All right, so we need to know what the price of the underlying is at that particular point in time. So let's insert a new column. We call it underlying price at time of contract. Not the underlying price at time of expiry, but underlying price at time of contract. That is to say, when we're evaluating all of this. And what is that equal to? That is equal to this price here. Now you might say, but professor, you didn't do a VLOOKUP. You just copied and pasted onto the screen. And that's fine. Because that number stays the same for all the options. All of this data, the price, okay, I'm going to make sure we view it correctly. We don't lose track here. Let's freeze the top row. Okay. So these are all as of today, as of March 7th at 10:30 a.m. The underlying price of the contract is 2,702 for all of these contracts. So we don't need to do a VLOOKUP because this is the only price that is relevant. Now, let's go back to our first contract, the first highlighted row. What is the call option here? This call option is the right but not the obligation to buy at $700 tomorrow when the price today is $2,702.94. Is that a valuable contract? Hongsheng.
Hi, Professor.
Is that a valuable contract?
I think it is a valuable contract.
Why is that?
Because the ask price, the price is lower than the price of the underlying price of the time of the contract.
Okay. Yes. So the price, it gives you the right to buy at 700. 700 is lower than $2,702. Of course, the price tomorrow is not going to be the same as price today. But even if the price goes down by $1,000, even then you make money tomorrow. Right?
Excuse me.
Yes.
Don't we need to consider the price of the call option or put options when we calculating the final payoff?
Well, I mean that we're trying to value what the option is. These are the bids and prices. We haven't done it yet.
Okay. Yeah.
All right. So in order to do that, then is what we will talk about is the moneyness or the intrinsic value of the option. So let's insert yet another column, and that will be different depending on whether it's for the put option or the buy option. Let's this is very annoying. So this here is for the left-hand side is for the call options. So the intrinsic value here is equal to the underlying price at the time of contract minus the strike price. So if the price, the price of the underlying security today at the time of the contract being written, if that is higher than the strike price, then the call option is in the money. That's the term that we use, it's in the money. If the intrinsic value is positive, then it is, the contract is in the money. How would you calculate the intrinsic value for the put option? So let's actually put in another column. So these here are the for the call options. These here are for the put options. So similarly, like we did for the intrinsic value of for call option, we will insert the intrinsic value of put option. Let's see, we call this the intrinsic value. What is the value of this option? The underlying price is $2,702 today. If the price remains the same tomorrow, then you're not going to lose money because nobody is going to force you to sell at $700, but you will choose not to exercise that contract. Okay, so this is, you will let the option expire unexercised, expire worthless. All right. So therefore, in this case, this is a situation where we say that the option is out of the money. So the intrinsic value is actually just the negative that it is for the corresponding put option. So this is equal to the strike price minus the underlying price at time of contract, and so on. So that's the phase, the intrinsic value, also known as the numerical moneyness. Now,
excuse me, Professor.
yes.
I think the intrinsic value should be zero because it expires worthless and we choose not to exercise the put. So why should it be negative instead of zero?
Well, if it is negative, then you choose to not expire it. So the
I think.
Okay, let's talk
Yeah.
off. Who's
Okay.
this? Sorry, I can't see who it is. I can't see who it is. Who is it?
Okay, this is issue.
How do you spell that? I can't see you. Sorry. Could you go onto the screen, please? I can't see you. I'm sorry. Never mind. Okay. So look, this is just a definition. That is the intrinsic value. The idea is if the intrinsic value is negative, then you're not going to exercise it, which is why look at the prices there. This is practically a worthless option. Look at how much people are willing to pay for it. Zeros. These are practically worthless options. So what you are saying is to say the intrinsic value should be equal to the price. And that's, it's a definitional issue. That doesn't get you anywhere. Okay. So, so that is the moneyness or the intrinsic value. let's also introduce the idea of the normalized moneyness. So intrinsic value of call option, also the moneyness. So the normalized moneyness, that is equal to the intrinsic value divided by the underlying price. And that's a percentage. Okay. Similarly, this here, the intrinsic value or the moneyness, and the normalized moneyness is equal to this intrinsic value divided by the underlying price. And this is in percentage terms. All right. So we have, for all options that are being written for today, we are looking at all the data that we have. We are seeing we can look at all the moneynesses. Anytime this moneyness is positive, that's in the money option. I couldn't get the question, the person who was asking the question. So let's introduce this, the price of the option, which is the middle of the mid bid ask, which is equal to the middle of the best bid for the option and the best price for the option. So we'll think of this as the dollar price. Similarly, let's do the price, the mid bid ask for the put option. All right. So this gives us all the data that we're looking for on S&P 500 options on the S&P 500 security at this point in time, April 8th, 2020. The intrinsic values we have calculated, we've shown the face value, the normalized moneyness. We can see what the price of this particular option is, and so on. So once again, going back to our favorite particular option, we have had, let's just remove all the highlights and highlight that again. No fill. Let's look at, all right. So what do we have here? The first row 3, which is for the call options. It's a call option which expires tomorrow. The underlying price today is 2,702. The strike price is 700. So it is heavily in the money. The call option, the put option is the intrinsic value. the moneyness of it is negative. That is to say, it is out of the money. When you normalize it, it's negative percentage. And as you can see, it is so heavily negative that it is a worthless option. So you can see that there is the bid and the ask. The people are not willing to pay essentially anything for it. It's still a little bit above zero because there is always a positive probability that the S&P 500 will drop from $2,702 today to $700 tomorrow. So that particular option will be exercised only if the price falls below $700 tomorrow. So that's what this is about. All right. So in the money, out of the money, let's just see. This is simply, you can see if you look at it, these the normalized moneyness. It's there are these negative numbers. There are these positive numbers. If it is positive, then it is in the money. If it is negative, then it is out of the money. When it is zero, then we say it is at the money. But then zero, you'll never get exactly equal to zero. So that's why we say if it is between close to zero. So let's say if it is between, so between -1% and positive 1%. These are ones we will refer to as at the money. All right. So at the money, where if the strike price is very close to the underlying price, in this case, you can see the strike price for the option in row number 168 is $2,680, where the underlying price today is $2,702. They're very close. It's a very good, excuse me, possibility that it will actually hit that price tomorrow. So therefore, this is at the money. All right. So is this clear about the different definitions of in the money, out of the money, at the money options, and the face value is the starting of this. By no means should you think that the just because the face value is negative doesn't mean it has negative value, because option, nobody can force you to buy something that's negative. So you will then choose not to exercise it, and something that if the strike price, the relationship between the strike price and the underlying price, depending on whether it's a call option or a put option, varies in that particular way that the option price is close to zero. All right, I'm going to save this. What happened here? Okay, we're losing a couple of people. Let me go back to make sure we have covered the slides. Right, so exchange traded options, we have primarily stocks, futures, American. Those tend to be Americans, and that's why I put you through the examples where in American exchanges, actual individual securities, individual equities are all traded as American options, whereas indices are traded as European options. The difference between an American and a European option is simply whether you can exercise it before the maturity date or not. All right. So these are the definitions of moneyness. And as I mentioned, in practice, we typically use a neighborhood to calculate, to determine whether call something in the money or at the money. Options provide financial insurance. Please go through them. The things that we will, because options are so important as part of overall portfolios. So the starting point of an option is what we call a naked option, which is considered, which if you have what we have done so far, an option by itself is called a naked option. And they can have four kinds. You can have a long call. You can buy a call, you can sell a call, you can buy a put, you can sell a put, and so on. I will then show you how these payoffs are determined. Okay. This is another data set called option metrics, which I will walk you through a little bit later, depending on how much time we have. But for now, let's just focus on the data that we have here in terms of actually generating the data, downloading it, etc. Let's worry about it at a little bit later. So these are the data sets that this is what we saw from the CBOE data is looking at data into the future, only at a snapshot in time. So whereas option metrics provide you with historical data, which is useful for certain things. A snapshot data is useful for certain other things. It's a very data-rich environment, and it really helps us understand these things better. So let's say we look at the data for our option prices being done, let's say the last week of December. All right, and so these are the various expiration date. So this then we calculate the duration. That's simply expiration date minus the date at which it's been calculated, what the duration is. Let's say we look at all the call options. In option metrics, they actually report the column as strike price times 1,000. So in order to generate the strike price, you have to divide this column by 1,000 to get the strike price. This underlying price, because it changes now because you're looking at historical data, you need the underlying price on the different dates of maturity. So you will need to do the VLOOKUP to get the price at the particular date of maturity. In this case, we are looking at just Facebook security, the underlying prices for the last, the 4 trading days of December. So we calculate the underlying price at date of price. Moneyness, as we have discussed, if it is if that difference is negative, then it is out of the money. If it is positive, then it is in the money. And if it is close to 0, then it is at the money. That's how we determine from the normalized. This is the numerical moneyness. Also, the intrinsic value. This is the field column K is the best bid. Column L is the best ask. We take the mid of that, and then we normalize the mid bid ask to divide this bid ask of the price of the option by the price of the underlying security. Okay, we're just looking at all possible scenarios, and we're trying to understand how these things work. So these are the data for Facebook. All options. This spreadsheet is all call options on Facebook security that were transacted on during the last week of 2017. That's what this data is. I'll walk you through how to actually download and generate this data in a short while. But for now, this is how we get all. This is the data for the call options. This is the data for put options. This is the data for underlying. That's what we need to generate these payoff diagrams. How does it work then? Sorry, I could not catch your name. The person who was asking about the sign of the intrinsic value. Could you kindly try to come back on the screen, please? This is, have we lost her? Have we lost? Okay. If not, please send me an email, okay? Because you clearly deserve class participation points. And this is the graph that we need to understand about what's going on. So here on the horizontal axis, I have put the numerical moneyness or the intrinsic value. All right, but that doesn't mean that people will, you're being forced to pay negative for it. You will just not exercise it. All right. So so what we then see, if we plot these values, what are we plotting? On the horizontal axis, we have the numerical moneyness or the intrinsic value. And on the horizontal axis, we see the price of the option. And this is the interesting thing, that if it is very negative, it is 0. And then as the moneyness becomes positive, then the option becomes more and more valuable. And this hockey stick, as it's referred to in the literature, operates. Now, this hockey stick, as you can see, it has various different aspects, different components, different parts to the hockey stick. Right at the bottom is which expire very soon into the future. Okay, if it's expiring tomorrow or in a week, or then it is, the price depends very heavily on the moneyness, the numerical moneyness, because the probabilities of it changing very much are pretty close to 0. So if it is, the intrinsic value is negative, the value will be 0. On the other hand, if you go to the higher parts of the same graph, if the relationship between intrinsic value and the price, intrinsic value versus price or value of the option, becomes quite different. It's not just intrinsic value. It depends a lot on the fact that it can change between now and the expiry date. All right. So so remember, at the end of the day, your option is the value of the option depends on the price at the time of expiry. Rather, I stand corrected, because we are doing it for an American option, the price at maturity, and you have the right to exercise this option anytime between now and maturity. So this is a different from a European option. And in this American option, for something that expires substantially into the future, it is not as a jerkier curve. It is a much smoother curve for an option that expires in the future. It depends absolutely on the intrinsic value, on the numerical moneyness, but it also depends on other factors going forward. The point to note is, if it is the closer the maturity, the lower the time to maturity it is, the more steep this hockey stick is. So this is, once again, if you plot the price versus value versus intrinsic value, or if you can want to say value versus intrinsic value, then it gives you this hockey stick picture. Similarly, if you do it for a put option, you get a similar picture. Of course, the intrinsic value is calculated negative of how it is for a call option, of course, because it's it's selling rather than buying. But if you get a similar hockey stick picture with options that are lower levels of maturity that expire in the near future are determined much more closely. The values, the prices are determined much more closely to this very very jerky, kinky hockey stick. Whereas for options that expire substantially in the future, it is a much smoother curve. All right, so once again, this is something we will explore in more detail when we do option pricing and the Black-Scholes formula and all of that stuff. This here is to understand the dependence of value on intrinsic value, all right, of price on numerical moneyness. You can use certain other variants. You can look at the normalized, and so you say, okay, why is the actual price important? Why isn't the normalized price important? So yes, you can say, okay, let's plot the normalized price versus the normalized moneyness. You see a similar hockey stick. If you were to do for put options, you do the normalized price versus normalized intrinsic value, normalized value versus normalized intrinsic value. You see a similar hockey stick picture with options that expire in the future having smoother hockey sticks than options that expire in the recent future. All right, let's pause for let's say 15 minutes. It's 11:30. Let's regroup at 11:45.